Imagine opening your trading app expecting profits, but instead, Nifty is on a wild roller coaster. One day it's hitting record highs, the next it's plunging, leaving you anxious and glued to your screen. This is market volatility, dramatic ups and downs driven by news, global events, and investor sentiment. In recent years, we've seen Nifty swing hundreds of points in a day, thanks to inflation scares, elections, and global shocks. For new investors, it's stressful. One moment you're planning a Goa trip, the next, you wish you'd stuck to fixed deposits. Volatility is the price for high returns in equities. But is there a way to invest without all this drama? Before we answer that, let's understand what volatility really means. Markets react instantly to news, good or bad, causing sharp moves. For long-term investors, these dips can be opportunities, but for those needing money soon, it's a headache. Equity investing is thrilling, but not always relaxing. So, what's the alternative? Volatility is simply how much an investment's price jumps around. Think Mumbai monsoon, sunny one minute, pouring the next. That's high volatility, like Nifty. Low volatility assets are more like Chennai in May, predictable and steady. High volatility means bigger, faster price swings. Low volatility means calmer, slower changes. Many prefer low volatility assets for peace of mind. Imagine driving to Pune. The expressway, stocks, is fast but risky. The old highway, bonds, is slower but steady. Volatility is the difference between a smooth drive and a wild race. If you have years to invest, you can handle the bumps. But if you need money soon, volatility can ruin your plans. Match your investments to your goals and risk tolerance. Don't lose sleep over your portfolio. Understanding volatility helps you manage risk. Choose wisely. Enter bonds, the calm, reliable heroes of investing. Buying a bond means lending money to the government or a company and getting regular interest in return. Unlike stocks, bond payments are fixed and predictable. For example, a 10-year government bond with a 7% coupon pays you steady interest every year. Bonds are called fixed income for a reason. They offer stability when stocks are volatile. Adding bonds to your portfolio cushions the blow when equities fall. During recent market corrections, government bonds stayed steady while stocks dropped. As of now, 10-year Indian government bonds yield around 7%, a safe, stable return. When markets panic, investors flock to bonds for safety. Sometimes, predictability is the smartest move. Let's compare Nifty equities versus bonds. Equities offer high returns but come with high risk and wild swings. Bonds provide steady income and lower risk, but returns are more modest. Stocks can make you rich or anxious. Bonds help preserve your capital. Government bonds are especially safe, backed by the government itself. Here's the breakdown. Equities mark growth, high risk, high volatility. Bonds, stability, lower risk, predictable income. Even bonds have risks, like interest rate changes, or for corporate bonds, default risk. If interest rates rise, your old bonds may lose value, but government bonds remain the safest bet for stability. The key is knowing what fits your goals and risk appetite. Don't put all your eggs in one basket. Balance is everything. So, Nifty or bonds? The answer is both. Diversifying between equities and bonds is the smartest way to invest. Asset allocation is like having both an accelerator and a brake, growth and safety. Your mix depends on your age, goals, and risk tolerance. Younger investors can take more equity risk. Those nearing retirement may prefer more bonds. There's no one-size-fits-all. Find what works for you. Remember, this isn't investment advice. Always consult a financial advisor. Investing is a marathon, not a sprint. Balance Nifty's thrill with bonds' chill for a portfolio that weathers any storm. That's true investing zen. Happy in